Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, and I have Adam Sarhan on the line, and he is founder and CEO of Sarhan Capital. Well, you took a break out from Cyber Monday shopping to join us on today's show. How you doing?
We're doing great. How's everybody in your end?
We're doing good. We're doing good. So let's just start here before we go into the individual stocks and commodities. Let's just get a take on your macro view. 2 days removed from hitting an all-time high in the S&Ps. We got some pressure on the financial markets today.
Sure. What happened was, if we step back and we look at the month of November, since today's the first trading day of December, we can see a two consecutive monthly gain and a very, very strong gain for that matter for the S&P. What happened was in the middle of October, exactly on October 15th, we had a bottom. And then since then, stocks were just ripping higher. And the concept or the fundamental backdrop was the evolution of the Fed put. The concept of the Fed put is that the Fed's going to step in whenever the market gets in trouble, or the economy. So if Main Street or Wall Street gets in trouble, the Fed's going to step up and help, whether it's QE or it's some other type of, laboratory experiment that they come up with. The point is that Fed put was an underlying bid for stocks for many, many years. QE3 ended at the end of October. So stocks sold off in the first half of October in the anticipation that, hey, QE3 is going to end. When QE1 ended, the S&P fell 17%. QE2 ended, the S&P fell 20%, just over there, 21%. And now what's going to happen when QE3 ends? But what we saw was, interestingly enough, a very strong bottom in the S&P on October 15th, and then all of a sudden, stocks ripped higher. In the next 2 to 5 weeks, we saw a gain of about 12% in the S&P, which was enormous, enough to not only repair the damage from that little decline, but also to send stocks back to new all-time highs. So in the month of October, the S&P was trading like a penny stock. It fell 8% in the first 2 weeks, and then it soared about 10 or 11% in the second 2 weeks. Then, in the month of November, it grinded higher. Every week, it kept on going higher. So obviously, the next question becomes why. The Fed put evolved to a central bank put. Almost instantly, I mean, the timing is borderline. I don't even want to put the right word in there. You can draw your own conclusion. But very interesting timing, for lack of a better word, that all of a sudden QE3 ends, stocks begin to sell off, then the Bank of Japan comes out with super aggressive monetary policy from their end. And then the European Central Bank does as well the following week. And then you have the Central Bank of China come in, and all three central banks, second QE3 ends, each one of these major central banks step up with some form of easy money, and they throw it into the system, and that was enough to propel stocks to new all-time highs.
Going back to the Ebola lows there, I mean, such a quick V bottom. You really had to be standing in the face of fear to participate in that. Did you just kind of hold your positions through it, or were you fortunate enough to be a little bit light on the long side and have some cash to deploy? Very very difficult V bottom to trade. How did you attack it?
Yeah, no, it's very, very difficult. Whenever you have an S&P 500, which is a major benchmark for the world, not just the U.S., trading like a penny stock, again, down 8% in the first 2 weeks and then up 10% in the second 2 weeks of October, that's a very, very difficult environment for anybody to trade who's an active trader and just not a buy and holder type of an event. So what we did was we locked in profits in the first half of the month, and then we began scaling back in the second half of the month.
Wow, what timing! So now we're up at all time highs, pulling back a little bit is what I said. Did we already have our Santa Claus rally?
It's very possible that we had the beginning of a rally. Now what happens when you see the market rally so strong in such a short amount of time? And remember, back in normal days, non-QE days, a 10% rally for the entire year was considered healthy. What we just saw was a 12% rally in just about 3 weeks or 4 weeks. So right now, the market's very extended to the upside, everything aside, and it deserves the bullish benefit of the doubt. It's deserved the chance to pull back a little bit, consolidate that gain, and then begin another leg higher. Whether or not it moves higher or doesn't move higher is still yet to be determined, but more importantly, from a very short-term point of view, we are very extended. We had a very big run without any type of a pullback, and to buy the dippers out there that step up and buy those dips haven't been able to buy over the last 5 or 6 weeks because the dips have been virtually non-existent, and that in and of itself is very bullish.
And just going back, talking about the QE for the world here. I mean, definitely was tailored and specific for our economy, and from what we've seen, has had the desired effects. Do you think the other countries or European Union that are looking to institute this policy, different structures, different economies, different factors, is it going to have the same desired effect?
It depends on where you're sitting. There's two desired effects from the U.S. point of view. I mean, the Fed has a dual mandate, right? So they want to maintain the overall employment figure. So in other words, help Main Street, but also they have a target of 2% for inflation. So the global central banks more or less have the same, not exact two mandates, but they have the same outlook where they want to help Main Street and they also want to make sure inflation remains at bay right around the 2% mark. Deflation is not healthy for the economy over the long term. The consumer says, hey, I want prices to come down, so what's wrong with deflation? Let's take a little bit of it. The problem is it's a slippery slope. So once one deflationary domino falls, it's very, very quick. All the other dominoes fall as well, and that becomes a snowball that just spirals out of control. And that's where the concern is from these central banks. So when they look at it from a risk-reward standpoint, hey, should we do more QE? What are the risks? I mean, if you're just sitting there, let's talk about the pros and cons, right? So if you were in that boardroom and you're making that decision, well, the risks are hyperinflation. I mean, that's just the absolute worst outcome that could occur from printing billions of dollars every day to stimulate the economy. But after 5.5 years of doing this, and we're more concerned with deflation right now than inflation, at risk is virtually not there at this moment in time. Could it build up and be like a tipping point where one day all of a sudden inflation kicks in? Sure. But at this stage of the game, because the economy, the demand component, price is a function of supply and demand. So that demand component remains lackluster at best. Inflationary pressures are just virtually nowhere to be found. And that's why all these central banks can not only err on the side of easy money, but they can actually go out there and be aggressive about it and print without any type of concern, because the worst case scenario for them is inflation, and that's nowhere to be found across most of the modern world right now.
Okay, so let's move into the crude oil market. I believe when we had you on before, you were playing it from the short side. Correct me if I'm wrong. And boy, you had the washout today. You took it down to 63.72 here. Is it time to look for a bottom in the crude oil market or not quite yet?
Not quite yet. When I was on, I believe it was not last month, but the month before with you, crude was right around $90. And I said, hey, listen, we're short. We had shorted it and shorted more at 89. Crude just imploded, and it continued to fall almost every single week. Last week, OPEC met, and they decided not to cut production. So even though crude oil prices are now down 40% from their highs in June, and that by definition is a bear market. So just to be clear, right now, there's a bear market in crude oil and also in gasoline prices. We had a post over the weekend about that on sarhancapital.com. That's free to everyone can read it. And it's basically saying that this bear market is good for the economy. So why are falling oil prices good for the economy, one might ask? There's two concerns there. First of all, there's demand destruction. So demand destruction occurs when people just simply are not buying that commodity. So supply, again, price is a function of supply and demand. So supply more or less has been level. Now increasing because of U.S. shale and all that fun stuff that's happening in North America with the Canadian oil sands, But more or less, that demand component just isn't increasing accordingly. So that's why there's a lot of downward pressure. Also, a lot of the geopolitical risk that occurred in the first half of this year, Ukraine, Russia, Israel, Palestine, are just removed. They're off the table at this juncture. So as far as threatening global oil supply, Iran, that situation has been also put at bay. So those geopolitical risks have eased dramatically. Demand just has not picked up. And if anything, we saw Japan was in a recession last quarter. So demand itself is falling or just stable, and supply is increasing, and that's a perfect storm for lower prices, and that's exactly what we're seeing.
And let's just go right into the gold market. Boy, we had a washout in the pre-market trading, down to 1141.70. I believe the low of the move was 1131, so you didn't quite get to the low of the move there. Prior low of the move 1131.10. I was noticing for the majority early last week and the end of the prior week, it was really struggling with the $1,200 level. You had a series of sessions where you got over 1,200, was not able to post one close off that level. Are you just going to kind of play the gold with the crude here and play from the short side until it gives you a reason to play it otherwise?
Yeah, I mean, full disclosure, we have been short gold most of this year and have done very well. Even last year with that whole 100-point decline, we were short before that in 2 days. So just full disclosure, we are short gold. But from my standpoint, I want to look at the intermediate and longer term trends, and that's clearly down. Just like in crude oil, it's in a bear market. Well, gold's in a bear market as well. The all-time highs were 19 and change, just below 2000, hit in 1923.70, hit back in September of 2011. And since then, for the last few years, it's been steadily falling. And now gold is somewhere in that 30% area below its all-time highs. So I'm operating with the notion that gold is in a bear market. Rally should be sold. If you notice last week or the last few weeks, gold rallied from deeply oversold levels, but hit a wall right near its declining 50-day moving average and its downward trend line. To me, that's resistance. So as it rallies into that area, you want to step up and short. And then if it breaks above it, you can cover because it's a favorable risk-reward entry point. If it doesn't and it rolls back over, which is exactly what happened last week and then again this week, you're in a situation where you have a very nice risk-adjusted entry point and you can short more on the way down. Last night's reversal, very strong. Silver, which most people don't look at, was even stronger. Overnight, silver was down over 4%, and now it's up. That in and of itself, in the short term, bodes well for both gold and silver.
Okay, are there any sectors that, I mean, we've had a nice rally in the market. Are there any sectors out there you're still finding some value in?
Yeah, there's a lot of areas that look attractive to us on findleadingstocks.com monthly newsletter we put out. There's a few new breakouts that are emerging. We like to buy advanced entry points in leading stocks. So in other words, instead of buying above resistance, which is a breakout level, it's the obvious level. And as you know, the obvious rarely works on Wall Street and in life for that matter. We've developed a system, advanced entry points. So if you go to findleadingstocks.com, click on the store, you can see exactly the logic right there with annotated charts on what we do. So that being said, there's a few working orders we have there, and in every report we give 10 to 20 new early entry setups for our members' review. So in other words, if you want a steady flow of new ideas, you can go out there and take a look and say, oh, this looks good. If it breaks out above the advanced entry point, we'll get in way before resistance is broken. It's a classic breakout. So we have the advanced breakouts, or the advanced entry points rather, and then the classic breakouts. That being said, you can take a look at something like SPABA, which is that Alibaba stock.
Mm-hmm.
On a daily chart, you had a very nice IPO base, did a very nice breakout, looked like Google 10 years ago, interestingly enough, and now it's forming a little bit of a handle here, a little downward trend line. If it gets going and it breaks out above that advanced entry point of ours, which for full disclosure to show you what we do each week is would be above the high of 1125 of 115.17. So if it gets going and it takes out that high, more likely than not, there would be a good place to enter. Not to give away any more of the buys,
Of the
but if you
secret
want to go
sauce
in there
there.
and look at the report, yeah, I mean, that's just a good example of what we look at.
And do you have just going back to the gold here real quickly? Do you have a
Sure.
target for gold on the downside?
No, instead of targets, we tend to interpret what we're happening. All I can tell you right now, the downtrend is well intact, and odds favor lower prices will follow. If you step back and look at as long as that 1130 level holds, I mean, the first target is 1130. If that level is not broken, which so far I've got to give today's big reversal a lot of bullish benefit of the doubt, because what happened was it sold off hard overnight after that Swiss vote, and then he had a big buy tail, a big positive reversal. Same thing happened on the 7th of November, and it just jumped right back to the 50-day moving average. So right now I have it in the trading range between the 50-day moving average and that 1130 level. If 1130 is broken, that would be a new technical sell signal, and then I have to expect it to test that 1,000 level, just because that's a psychological round number.
And any sectors that you may be looking to take some profits in, maybe a little bit, they've gone a little bit too far, too fast, and you're looking to trim things back a bit?
Yeah, take a look at the SMH, which is more or less the semiconductor stock. We've had a huge move there. Huge move. It's very extended. and it's overdue for a nice little pullback here. So if you're a shorter term trader, you want to trade it, that's a good place. The IYT, the transports, big run on these falling energy prices because they benefit from that area. As far as undervalued areas or new emerging areas, take a look at housing. The XHB. NARB had a big base breakout a few weeks ago, and that was illustrated in the report also. You have the retailers, which are starting to wake up again. Again, these lower energy prices are bullish for this fourth quarter shopping season and for these retailers because consumers have more discretionary or disposable income. So when you don't pay that much for energy prices, whether it's gas prices or nat gas, whatever the case is, but in general, that means you have more money in your pocket. And consumers, on average, when they have more money, they spend more, especially in the fourth quarter holiday shopping season. So that bodes well for the XRT and a lot of the individual retailers that we have in her report.
And before we let you go here, you got your comments on the semiconductor sector, looking a little extended rally. How about the biotech sector, short term?
Yeah, the biotech's another good area. It's a very strong area. It is as well a little bit extended here. You had a very strong rally several times this year. You had a big sell-off in March and April, and then it somewhat placed a near-term bottom, and then it just soared. And it went more or less from May, it ripped higher all the way up to October, pulled back again, and then it ripped again higher, and now it's sitting near new all-time highs. The IBB, that is, for that matter. Underneath the surface, there's a lot of bullish areas or stocks in that group, and biotechs in general are one of the strongest sectors or industry groups, rather, that have emerged since that March '09 low 5.5 years ago. So for the entire bull market, one of the strongest areas has been these biotechs, and I see no reason for that to end going forward.
Okay, and just final tips or thoughts for investors going in. We starting the last month of the year here. Santa Claus rally, January effect. Any final words?
Yeah, I definitely risk at this stage of the game. Getting very aggressive would not be prudent because we've already had a very big move off these lows in mid-October. And in a bull market, you want to spy weakness, not just strength. And that's one of the things that we one of our philosophies, our core principles. And then in bear markets, like in the commodities, look to sell strength, not just sell weakness, because those retracements, which are normal, in other words, a pullback in an uptrend, is a much better entry point, risk-adjusted entry point, than just chasing and buying a new breakout to a new high.
Okay, Adam Sarhan, founder and CEO of Sarhan Capital, joining us here on Benzinga's pre-market prep, brought to you MarketFi. Adam, thanks for your diverse outlook on the market. We hope to have you back on again soon.
Thank you. Happy holidays and happy new year to everybody.